The rise and fall of WeWork, unpacking the high-profile collapse. Former high-flying startup WeWork Incorporation filed for bankruptcy, listing nearly $19 billion of debt. A fresh low for the co-working company that struggled to recover from the pandemic. The New York-based company had said that it had struck a restructuring agreement with the creditors representing nearly 92% of its secured notes and would streamline its rental portfolio of the office space. The November 6, Chapter 11 filing in New Jersey listed assets of $15 billion. WeWork's collapse into bankruptcy is the culmination of years-long saga for the company, which was once the biggest office tenant in Manhattan. Its sudden rise and steep fall have captivated the Wall Street and the Silicon Valley alike. The firm's undoing arguably started in 2019. In a matter of months, the company went from planning an IPO to laying off thousands and procuring a multi-billion-dollar bailout. To really understand why a company worth billions failed, we need to first understand how it grew and reached its pinnacle. This means examining what a company did to get famous, its milestones, and its best valuation. Knowing all this can help us understand where all did the company go wrong and the weaknesses that led to its fall. The rise of WeWork. WeWork's rise was symbolic of a new era in workplace dynamics, aligning perfectly with the gig economy's ascent by offering versatile workspaces that catered to the independent contractor and burgeoning startups alike. Its inception in 2010 marked the beginning of a revolutionary service in the commercial real estate, providing trendy, well-equipped communal offices with allure of month-to-month flexibility as opposed to the traditional long-term leases. This innovation struck a chord with the market, leading to the rapid expansion of WeWork spaces across the global urban landscapes. The company's expansion strategy was bold and aggressive, characterized by rapid acquisition and transformation of large office spaces into aesthetically pleasing, community-oriented environments, complete with perks and amenities that appeal to the modern worker's desire for convenience and social connection. This not only included freelancers but also attracted large corporations seeking to decentralize their workplaces or to offer more adaptive environments to their employees. Financially powered by a wave of venture capital, with SoftBank's backing as a standout. WeWork's valuation skyrocketed to $47 billion, a testament to the investors' confidence in the shared economy model and WeWork's execution thereof. The model hinged on scaling up quickly, optimizing the use of rented spaces to generate revenue that could support further expansion. WeWork became a leading example of shared economy, showing how shared and flexible workspaces can really change the office rental market worldwide. Now that we have understood how WeWork quickly became successful, let us look at the reasons behind its fall. Moving forward, let us understand about what went wrong and what problems hurt the company. WeWork's collapse can be attributed to several factors. Unsustainable business model. WeWork's business model was built on long-term leases that locked the company's fixed costs, while their income based on short-term memberships was variable. This mismatch created a financial vulnerability that was difficult to manage during the economic downturns, overvaluation and overexpansion. The company was aggressively overvalued at $47 billion during the last funding round before the attempted IPO. The valuation was based on rapid growth and expansion into new markets and offerings beyond core co-working spaces, stretching the company's resources thin. Corporate governance issues. There were significant issues with the governance of the company, especially with regards to the actions and control by the CEO, Adam Newman. His outsized influence, unconventional behavior, and self-dealing transactions raised red flags to the investors. IPO and public scrutiny. The attempt to go public brought intense scrutiny to WeWork's financials, revealing massive losses and no clear path to profitability. The S1 filing raised more questions than it answered, leading to crisis of confidence amongst the potential investors. Economic and market conditions. The market conditions at that time did not help. As the economic market started to show signs of downturn, the real estate market, especially the commercial real estate, began to look riskier, affecting companies like WeWork that had significant exposure to the market cycles. High cash burn rate. WeWork's operating model required significant upfront investment to refurbish spaces and make them WeWork ready. This led to a high cash burn rate without a proportional increase in sustainable revenue, which became increasingly untenable. COVID-19 pandemic. Although not a factor during the initial collapse, COVID-19 pandemic increased WeWork's problems. As companies shifted to remote work, the demand for office spaces reduced, leading to further loss of business for WeWork. Together, these issues created a perfect storm that led to WeWork's dramatic fall from grace and necessitated a substantial bailout and restructuring to avoid bankruptcy. After looking at the big mistakes and problems that led WeWork to struggle, let's get ready to wrap up what we have learned from its story of success and trouble, navigating aftermath and seeking stability. WeWork's brush with disaster serves as a testament to the complex interplay between market innovation and economic fundamentals. In the aftermath, the company underwent significant downsizing and strategic overhaul to fortify its balance sheet and restore stakeholders' confidence. While it has since resumed a more calculated and conservative path of recovery, the lasting impacts of its near collapse continue to inform debates about valuation metrics, growth trajectories, and sustainability of the business models in dynamic tech and real estate sector. As a paradigm of a larger conversation about responsible entrepreneurship and investment in the startup ecosystem. WeWork's story will likely be studied for years as example of perils of unchecked ambition and enduring value of traditional business prudence. For more informative content of this sort, do reach out to Savat.